Hello everyone. Today we are discussing one of the important topic in accounting, that is basic terms in accounting. Here we discuss 9 basic important terms in accounting. They are proprietor, capital, assets, liabilities, drawings, goods, debtors, creditors and stock. Before going to the topic, we have to know what is accounting. Accounting simply means the process of recording business transactions in the books of account. Accounting is the process in which the business transactions are recorded in the books of account. Next, the basic terms in accounting. First one, proprietor. Proprietor means the owner who start a business for the purpose of earning profit. Proprietor is the owner who starts a business. For example, Mr. Raju started a stationery shop. Here, stationery shop is the business and it is started by Mr. Raju. So here, Mr. Raju is the owner of the business. Owner means the proprietor. The next term, capital. Capital means the amount or assets invested by the owner in the business. Capital can be invested in two forms, that is in the form of cash and in the form of assets. Capital is the initial investment made by the owner in the business. For example, Mr. Raju started his stationery shop by investing rupees 1 lakh in his business. Mr. Raju started a new business, that is stationery shop business, and he invested rupees 1 lakh in his business to start the stationery shop. So in this case, rupees 1 lakh is called as capital of the business, which means the initial investment made by the owner to start a business. The next term, assets. Assets are the valuable things or properties owned by a business. Assets are the valuable properties owned by a business. For example, in the case of stationery shop, Mr. Raju purchased a furniture costing rupees 50,000 for keeping the stationery items. In the case of stationery shop, purchase and sale of stationery items are the main activities of stationery shop. So in this case, Mr. Raju, that is the owner of the business, purchased a furniture for keeping these stationery items. So in this case, furniture is the asset. The next term, liabilities. Liabilities are the debts owned by the business to outsiders. Liabilities are the debts owned by the business to outsiders. These are the amount to be payable to outsiders. Outsiders means the persons or institutions outside the business. For example, Mr. Raju borrowed a sum of rupees 10,000 from a bank. In this case, it is the responsibility of Raju's business to repay the amount to bank on a future date. So that we can say that liability means the obligation to repay the amount on a future date. Next term, drawings. Drawings means the amount or assets withdrawn by the owner from the business for personal use. Here, drawings can be in two forms, that is in the form of cash and in the form of assets. So, drawings are cash or assets withdrawn from the business by the owner for his personal use, not for business purpose. For example, Mr. Raju withdrew rupees 5,000 from his business for paying his life insurance premium. In this case, life insurance premium is the personal expense of Mr. Raju. So, he withdrew rupees 5,000 from his business and it is used for paying the life insurance premium. So, here rupees 5,000, that is the cash rupees 5,000 is called as the drawings of the proprietor. Next one, goods. Goods are the things which are purchased and sold by a business. In the case of business, goods are purchased for resale. For example, Mr. Raju purchased stationery items. Stationery items are the goods of a stationery shop, which means the items which are purchased and sold by the business. Here the stationery items are purchased from other business and it is sold to customers. The next one, debtors. Debtors are those persons who owe money to the business. Debtor arises when there is credit sale. In the case of credit sale, there is no immediate payment of cash. The money will be settled on a future date. For example, Mr. Raju sold stationery items to Mr. Y on credit. It is a credit transaction. In this case, Mr. Raju will get the amount of sales on a future date. There is no immediate payment of cash. So here in this example, Mr. Y is the debtor of Raju's business. The next term, creditor. Creditors are those persons to whom the business has to pay money. It is just opposite of debtors. A creditor arises when there is a credit purchase. In the case of credit purchase, there is no immediate settlement. The settlement will be made on a future date. For example, Mr. Raju purchased stationery items from Mr. X on credit. It is credit purchase, which means the amount will be paid to Mr. X on a future date. So, in this example, Mr. X is called as the creditor of the business. The last term, that is stock. Stock means the group of unsold goods on a particular date. It is the group of unsold goods. Unsold goods means the goods which are not sold. Stock can be mainly divided into two, that is opening stock and closing stock. We know that in India, accounting period starts on 1st April and it ends on 31st March. So, opening stock means it is the value of stock. It is the value of goods unsold at the beginning of the accounting period. That is the value of stock on 1st April. And the next stock is closing stock. Closing stock means the stock at the end of the accounting period, which means the value of stock on 31st March. Here we discussed 9 basic important terms in accounting. I hope everything is clear. Thank you.